All right, let's get right into it. Congress just dropped a bombshell of a tax overhaul, and it's called the One Big Beautiful Bill Act. Seriously. And this thing, it's set to change pretty much everything, from what you see on your paycheck to how you plan for retirement. We're talking about a huge restructuring of the whole U.S. tax system, and today, we're going to break down exactly what it means for you.
So here's how we're going to tackle this. We've got 5 main parts. We'll look at the big picture overhaul, then what's changing for your paycheck, how it affects businesses, what it does to retirement and estates, and finally, what you really need to know.
So, you might be asking, why now? Why this huge bill all of a sudden? Well, it all boils down to a deadline, a really big one. A lot of people were calling it a tax cliff, and for good reason. It was a date on the calendar when taxes were set to automatically jump up for millions and millions of Americans.
Okay, so cast your mind back to 2017. That's when the Tax Cuts and Jobs Act, or TCJ, was passed. The thing is, a lot of those tax cuts were temporary. They had an expiration date, and that date was the end of 2025. If nothing was done, poof, they'd vanish, and almost everyone's taxes would have gone up. So this new bill, the OBBA, wasn't just about stopping us from going over that cliff. It was about wiping the slate clean and setting up a whole new, permanent set of rules for the future.
All right, let's talk about what this means for your paycheck, because that's what we all care about, right? This new act brings in a couple of new deductions. Now, they're temporary, but they are powerful, and they could mean more money in your pocket. We're talking specifically about income from tips and overtime.
So this is a really big deal. Before, it was simple. Every single dollar you made in tips or overtime was just regular income, and you paid taxes on it. End of story. But now, this new law creates something called an above-the-line deduction for both. And why is that huge? Because it means you can take this deduction even if you don't itemize. Even if you just take the standard deduction like most people do. This is a game changer for a lot of folks. Okay, let's look at the actual numbers. And remember, this is a temporary break that's on the books for tax years 2025 through 2028. So, if you're a tipped worker, you can now deduct up to a whopping $25,000 of that income. For overtime, it's up to $12,500 per person. And get this, if you're filing jointly with your spouse, that number doubles to $25,000. But there is a catch. You've got to watch out for the income limits. The benefit starts to shrink once your modified adjusted gross income, that's your MAGI, goes above $150,000 for single folks or $300,000 if you're filing jointly.
All right, shifting gears from personal paychecks to the business world, the bill is packed with some absolutely massive incentives. The whole idea is to get businesses to invest and build right here in the U.S. We're talking everything from giant factories to local farms. So, first on the list is this totally new thing called super depreciation. Sounds cool, right? Well, here's how it works. In the old days, if a company built, say, $1 million factory, they couldn't just write off that $1 million right away. No, they had to spread that deduction out over, get this, 39 years, a tiny piece each year. But now, with super depreciation, they can deduct the entire cost in year 1. It's a gigantic tax break aimed at making it way, way cheaper to build new factories and production facilities here at home.
Yeah, 100%. That's the magic number, a 100% immediate write-off. I mean, just think about it from a business perspective. If you're on the fence about building a massive new facility, this could be the thing that pushes you over the edge. It's a total game changer for a company's cash flow. It just makes the numbers look so much better, and it's a really powerful nudge to get companies building now. Okay, but like with any great deal, there's some fine print. There are some really important rules you have to follow to get this super depreciation. For one, there's a strict timeline. You have to start construction by the end of 2028, and the facility has to be up and running before 2031. Also, this only counts for the actual manufacturing part of the building, the factory floor. It doesn't apply to the fancy front office or the R&D labs. And here's the biggest one. It comes with a 10-year commitment. If you take the tax break and then stop using the building for manufacturing within a decade, you have to pay it all back. That's what they call a recapture rule, and it's got some serious teeth. And wait, there's more. It's not just about the buildings. Another huge pro-business piece of this is that bonus depreciation is back at 100%. So this is for all the equipment and machinery that goes inside the factory. We're talking computers, furniture, assembly line robots, you name it. If you buy it after January 19, 2025, you can write off the whole cost immediately. It's just another layer of incentive to get businesses spending.
This bill also has a special focus on rural and agricultural communities. There's a new rule in here, Section 139L, and what it does is it gives banks a really nice tax break. Basically, if a qualified lender makes a loan for a farm or for rural property, they get to exclude 25% of the interest they earn from their taxable income. So what's the goal here? Well, the hope is that if lending becomes more profitable for the banks, they'll do more of it, and maybe, just maybe, that'll mean lower interest rates and better loan terms for farmers and ranchers.
Okay, let's pivot and talk about the long game, retirement and estate planning. This is where the new law makes some of its biggest and most permanent changes. We're talking about rules that are going to give savers and families a whole new level of certainty for planning decades into the future.
So check this out. For 2026, the standard amount you can put in your 401k is going up to $24,500. That's great. But the really wild part is this brand new tier they've created. It's being called a super catch-up, and it's specifically for people between the ages of 60 and 63. If that's you, you can throw in an extra $11,250 on top of the normal catch-up contribution. That means you could be saving, over $35,000 a year, right as you're in that final sprint to retirement. That is huge. Now there's another twist here, and this one's for high earners. Starting in 2026, if you're 50 or older and you made over $150,000 in the previous year, there's a new rule for your catch-up contributions. All of that extra money you're saving, whether it's the regular catch-up or that new super catch-up, all of it has to go into a Roth account. So what does that mean? It means you pay the taxes on that money now, not when you pull it out in retirement. Your regular contributions, up to that $24,500 limit, can still go into a traditional pre-tax account, but the extra savings, that's got to be Roth.
Okay, this next one is absolutely monumental for anyone thinking about estate planning. Remember that tax cliff we talked about? Well, the estate tax exemption had its own cliff. The amount you could pass on tax-free was set to get sliced in half in 2026, dropping from almost $14 million down to around $7 million. This new bill slams the brakes on that. It completely reverses course, makes the exemption permanent, and then boosts it even higher to $15 million per person.
$30 million. For a married couple, that's the new magic number. They can now pass on a combined $30 million to their kids or grandkids, completely free from federal estate and gift taxes. The most important word here is certainty. For years, families have been doing all these complicated planning gymnastics, trying to deal with rules that might expire. That's over. This provides a stable, long-term foundation for wealth planning.
Phew, okay. That was a lot of detail, I know. So let's zoom out and boil it all down. What are the absolute must-know takeaways from this whole thing?
Okay, here's your cheat sheet. If you're a worker, you need to look into those new deductions for tip and overtime pay. Remember, they're temporary. If you're a business owner, that 100% write-off for new factories and equipment is a massive green light to invest right now. If you're saving for retirement, your contribution limits are going up, and there's that cool super catch-up, but remember the new Roth rule for high earners. And finally, for estate planning, things just got a lot clearer. That exemption is now permanent, and it is high. The years of uncertainty are finally over.
So here's the bottom line. For the first time in a long time, the rules of the tax game seem to be set in stone for the foreseeable future. The big question is no longer what if. The question now is for you. How does this change your financial plan? What moves are you going to make to adapt and really take advantage of this new landscape?